Sergio says, so less supply, more demand, prices go up, right? And we're about to talk about pricing and where price is at, but this is a great way to frame it. We as investors are buying now at a premium, but that shouldn't affect our ROI long-term if we're in it for a full market cycle. That's his question. To me, when I hear months of inventory are way down and it is a seller's market, right? Like it is, you are as a buyer paying somewhat of a premium, but when you bring in this figure of months of inventory, that's a future looking indicator that yes, you may be buying at a premium, but it's not even close to the premium it's about to be, right? Is that kind of what I'm hearing?
Premium is an interesting word, right? So what people are doing right now is they're buying at market value, right? So that's what these properties are selling for today. It's the market value today. But that 1.6 months of inventory that we were just looking at, that is a future indicator of where pricing will be going absent of other things. Now, there's other things to consider. Obviously, this isn't the only thing, but this is a strong indication that pricing is probably going to be going up. So, the premium thing, we're not paying more than market value today. That 1.6 months of inventory doesn't mean that the market is overvalued. In fact, actually, the market is exactly on that trend line right now. In fact, Pablo, do you want to bring up that slide there? That's kind of appropriate right now, because this is something that is a little bit misunderstood, right? There we go, perfectly timed, right? So the market, while we're here, it's actually all the way through October of 2020, a little bit to the right of that June 2020, data line there. That is showing you that we are at 1.6 months of inventory. But if you notice that median sold price, the blue line, is almost exactly with the projected median price. That projected median price means that if our historically accurate home price appreciation played out every single year since 1991, what would it be at? Well, we're right there. So based on what our historical appreciation rate is, we're right there. So we're not overpriced. We're not paying a premium today. But what this means is that there's not enough supply to satisfy the demand. And when that happens, you probably are going to see price increases. And this is in the face of COVID. And this is in the face of our economy right now, right? We understand that there's economic pain out there, but the simple fact is that there's just not enough supply. There is a lot of demand right now. And even as we experience more in pain as an economy next year, it's not going to change the lack of supply. It's not going to change the fundamentals of the market right now to a point where you would see price declines, in our opinion. Now, what this means though, so we're not buying at a premium today. We're buying at the market value always. The market is priced appropriately based on the historically accurate projected price. It's just leading indicators that there's not enough supply. But I think a better question is, what is an investor going to find 1 year from now, 2 years from now, 3 years from now? What's the impact going to be on your future cash flows in an environment that plays out the way that this indicator tells us it's going to, that pricing would be going up, right? What is going to happen as interest rates go up in future years? They're not going to stay this low forever. They've never been this low. It's not a good thing for this to stay this low forever. So I think a good question is, what is the impact going to be to your cash flows? What is the impact going to be to your home price appreciation and your down payment required in the future when pricing does go up? Pablo, let's put you on the hot seat there. What do you see happening?
I'm glad you did that, because I was literally thinking, I'm like, okay, I was thinking through it. To me, it sounds like as interest rates go up and this pricing that's going to appreciate, the price is going to be higher and the cost of finance is going to be higher, which if I were to reverse engineer that into the investment I recently made, I would assume that would cut into my ROI.
Exactly.
I mean, it cut into my cash flow, right? And then therefore also my ROI too.
Your ROI as well. it is going to be increasingly more and more difficult. And this is not just a Jacksonville thing, or this isn't nearly as much of a JWB thing as it is for the turnkey rental investment space out there. It is going to be incredibly difficult for turnkey operators to provide positive cash flow properties in the coming years, because interest rates are going to go up. We see home values continuing to go up in most markets. We see it happening in Jacksonville over the coming years. And if you just run your evaluations and you add 1% to the interest rate, go to 5% instead of 4%, and you add, $10,000 to a purchase price because of 5% appreciation on a $200,000 asset, and you look at how slim those cash flow numbers get, that's the reality that people are going to find across the country. Turnkey rental properties are going to be really, really hard to come by in future years. And that's just the reality of it. Now, I don't want to scare anybody. JWB has been thinking about this for a long time, right? We go back a long time. In fact, even at the beginning of this conversation, Pablo, you started to ask about when we started to buy, build to rent. Why do you think we started to gobble up so much more land than we knew we were going to build and sell in that year, Pablo? Why do we do it?
Because you have the land priced in at the value that it is now, so that you can offer a property at just the construction cost, premium, not the land overall premium.
Exactly.
I just came up with that right now, right when you asked me, by the way.
Brilliant.
Yeah.
Brilliant. That was really good. I mean, that's it, right? This is what we do that's different than every other outfit out there, right? We looked at this and we said, this isn't an option for us to go out there and buy land. I mean, it is incredibly difficult to organize the amount of financial resources that we have. And we've been doing this since 2011, to go out there and buy a ton of land just to sit on it. Right? We have over 600 lots that we haven't even built on. And we bought over 600 properties just this year. And so we've been doing this and doing this and doing this. Why do we feel like we are in such a rush to do this, whereas other people are just trying to solve the problem of how do I get supply enough for my investors today? Well, it's because if you're not thinking 2 years ahead and don't have a runway of inventory 2 years, 3 years from now, these turnkey operations are just flat out not going to be in business anymore if they are just trying to sell existing renovated properties for cash flow, because interest rates are going to go up, home values are going to go up, and it's no longer going to be positive cash flow for them. So we're good. We're good in JWB. We've been planning this since 2011. We have plans next year to buy more lots than we're going to sell next year again. And that is there for our clients. It's to protect our clients. It's to protect our business. This is where it's going.